Good morning. Welcome you on the SEAF model. I'm Jack Kosar. This is effective for the week of January 19th, 2026. Let's get started. First kind of key thing to note here is that this data is through 1/15. So that is Thursday of last week. So we do not include any data here on today is Tuesday the 20th. So this data is not inclusive of any geopolitical wares that happened over the weekend. So just a key note here, again, data through 1/15. I will be talking through the SEAF table as the data is presented and avoid any speculation on Washington. So SEAF signals for this week. We retain industrials and we pick up energy and consumer staples. We had mentioned last week that energy was starting to show a little bit of life. It has now made itself a SEAF signal. We do have some nice scores here, all under 10. So that in terms of the alignment of the overall table, that is solid. Kind of key thing to note, utilities starting to make a little bit more of an aggressive play here. Grabbing my sheet real quick. So utilities coming in, heading into our heat map. Again, mostly positively aligned here in the sense that we have our greens here up at the top with the majority of our reds here toward the bottom. So the table is aligned in that sense. As you can see here, we have a negative correlation on healthcare going from 1 to 6 to 10. And we're seeing a similar opposite action here for utilities going from 9 to 7 to 2. That 2 is a 0.23% increase. Consumer staples looking relatively solid at a 0.43. I'd be remiss to not remind everybody that we did some studies on our own data, and a significant number for any particular sector on the trading week is above 0.4. So at a 0.43, consumer staples looks relatively solid. Plus, again, we like to see that transition. So from 5 to 3 to 1, that's a positively skewed transition. Things looking good for consumer staples. Nice, decent numbers here for energy industrials, 0.21 and 0.17 respectively. And for 3 and 4, that shows some nice positive movement to go along with some accumulation that these guys are that these sectors are picking up in the tactical month and the strategic quarter. Overall, 4 out of 5 days were up last week, with the exclusion of Friday being a down day in terms of the net asset flows into the 11 sector spiders, which is a good transition to head into our sector spider total AUM. Currently sitting above its 21-day moving average. As you can see here, in general, this up at the top here, we have the 11 sector spiders AUMs added together to create one number, and down here we have the S&P 500. As you can see here with this 21-day moving average, as long as the assets under management have stayed above that 21-day moving average, we've seen some nice price appreciation in the S&P 500, with little brief stints under, highlighting some of the bottoms that we have seen or minor bottoms that we've seen as of late. Again, this data is through Thursday of last week, so we do not have this current Tuesday's asset flows, which, as the market is currently down over 100 on the S&P 500, so would expect to see some outflows coming here out of this sector AUM. So come back next week to see what the chart pulls out. But again, overall, things looking relatively positive on the sector total AUM portion through Thursday of last week. Heading into our rainbow charts, I wanted to highlight financials. Financials went from really upper to mid favored, with a lot of asset flows coming out. This was really kind of headed off by Washington marking credit cards at 10%, which put a little bit of shockwaves into financials. As see here, relative outperformance turned on a dime as the money left this particular sector. Industrials. Industrials has been a really good play for us here as we've been staying in this upper favorite area, picking up some really nice relative outperformance versus SPY. We even have some room to run still, as our relative performance highs going back in the last year are still above our current mark. So industrial still has some room to run and looks to continue to be a good place to be. Energy's coming back in. We've been a little bit hesitant with energy going back to last year, as we've seen these inflows kind of come in and come right back out without seeing any kind of a sustained move. The positive thing here is the frequency in which we are sitting in this favored. Energy is trying to break out, has been a long downtrend. If I were to extend this chart out to more than a year, we would see a steady decline in the relative underperformance of energy versus SPY. We have seen multiple attempts here. Again, I like to see that this is getting grouped up a little bit more in terms of how often we're spending time in favored. Even though we do get a little bit of dip into a void, we are on a nice positive uptrend in the relative outperformance versus SPY. So things are looking positive for energy. Overall, starting to build up some accumulation in that strategic quarter, which is important for some of these sustained moves. Consumer staples shot up from really in a void all the way up into favored. Corresponded with some relative outperformance, seeming here bouncing off the bottom on the relative outperformance versus SPY. Consumer staples has lagged really better part of the last year to date. So interesting to see here that we kind of bounced off the bottom on that relative performance versus SPY. Currently a number one on the trading week with some pretty significant inflows, and then being carried really by that trading week. But we see that positive flow as we came out of a void through neutral into favored. So consumer staples currently a SEAF signal. Last but not least, I just wanted to show utilities. We did have utilities kind of drop down into void. We are sitting up into neutral. Utilities 2 on the trading week. Any kind of sustained increased flows here in utilities could get this thing up into that lower favored territory. This is not leadoff status per se, but just showing some interesting, as we kind of seem to have bounced off the bottom here for utilities in terms of the relative performance versus SPY, and we're entering into neutral with that strong trading week of with 2. So watch this space for utilities. That is all I have this week. I look forward to breaking down the SEAF model with you all next week, and especially incorporating some of the stuff that we're doing in terms of what's going on geopolitically. I'm not going to speak on that directly, but what I will say is the SEAF model does provide us some flexibility in the sense that we are rebalancing this on a week-to-week basis, and as new information hits the market, we can get out of sectors relatively quickly on that nature, because we are cycling this thing once a week. So, compared to some other asset flow type sector rotation models where they're defaulted by the quarter or by the half year in terms of how they align themselves with their overweights or underweights toward the 11 sector spiders, they might have to sit through some of these trends a little bit longer, whereas we are very active and dynamic with these with trading the SEAF model. So just kind of wanted to give a quick shout out to the SEAF model in the sense that, because of its understanding of the nature of sector rotation right now and how quickly a lot of these markets are moving, SEAF does a pretty good job of being agile and getting you into the markets that are going to be, at least outperforming the S&P 500, if not outright performing themselves. That is all I have for this week. I look forward to breaking down SEAF with y'all next week. Thank you.